Hey traders, I'm Noah. I have just turned a $1,000 deposit into over $30,000 profit with withdrawals of $3,000. My balance is still at $27,000. Want to know how? It's all about mastering strategies, managing risks, and making smart trades. And I can teach you how to do the same.
Today, our topic is about rabbit traps. In a strong movie downtrend, where the price give us lower highs, lower lows, lower highs, lower lows, price give us a higher high. Most traders start to expect that this is a sign of reversal because in the ideal uptrend or in the ideal downtrend, where the price is giving us lower highs and lower lows, when the price break a lower high, it give us the higher low and then start again the uptrend. Most traders are expecting the price to go higher, but the price do not go up. Instead, it again start a continuation of the downtrend and again make us this move. So why does this happen? And in our today video, we're going to discuss why the price give us the rabbit trap and how we can basically predict that in the future. Hello everyone. So today our topic is about how smart money trading basically works and what is rabbit trap. So we understand that when we take trades in the market, we take trades in the biggest and huge financial market in the world. That is Forex, crypto, stocks, and futures. So when we take trades using the brokers. Okay. And those brokers basically connect the buy trade of buyers, the sell trade of sellers. That means when buyers take a trade in the market, as he open the position and when the market runs in his favors, so as buyer is making a profit, but who on the other hand is losing the money that is resulting in the profit that the buyer is making. Most people think that the money that on the other hand the participant is losing, that can be the broker, but that is not a correct answer because when you take a buy trade, your buy trade is basically connected with the sell trade of a seller. That means when the price goes in your favor, you make the profit, but on the other hand, the profit that you're making is the money that a seller is losing with his sell trade. That means if a person wants to buy any trading asset with a position of $1 million, his buy trade will be connected with a position of $1 million of sell. Okay, that means +1 -1 is equal to 0. That means as both trades has been connected, so if someone is making the money, it will be resulting as a loss for the other participant. So now we understand this thing. But what if what if on the market, if someone wants to add a position of $5 million, but on the other hand, seller is only present with a $1 million position. If we consider the whole market cap, in that case, the position of $5 million will not be open. Why? Because there has to be always equal sellers versus equal buyers to open the position. Because someone has to make the money, so the other will lose the money. Okay, someone has to lose the money there. But if on the other hand the participants are not basically with equal orders, so that position of $5 million will not open because only the $1 million order will be filled and the rest $4 million will be rejected or unfilled. So that is not a problem for us because daily trading volume of Forex is like $5.6 trillion. Okay, so that is the reason we have a lot of liquidity in the market, and when we take the trades, it is always accepted and always open right at the price where we want the price to be executed for our order. But that does cause a problem for the smart money, because what if the smart money wants to open a position of $50 billion? And by smart money, I mean Wall Street institutions, central banks, and hedge funds. If they want to add a position of 50 billion as a long position, but on the other hand, the sellers are only present with $10 billion collectively. So as $10 billion is not equivalent to $50 billion order, so their position will not be opened. So in order to open the position, they use these 4 methods to open their position. The first method is respect of trend to add more position. Second, respect of highs or lows to add more position. Stop loss hunt to open huge positions. And traps to add huge positions during short period of time. But how they do that? As if they want to open a position of $50 billion, but on the other hand, sellers are only present with $10 billion, they have to attract more sell orders, right? Because they will not change their order. They still have to open a position of 50 billion. But as the sellers are only present with $10 billion, so they basically follow some methods. By using those methods, they activate the opposite traders to open their orders. Means if they want to open a sell position as their original order and they want the market to go in the downtrend, first they're gonna open a buy. Because when the institutes open a buy, it basically creates a swing high on the market. So when institutes open a buy, as it creates a swing high, multiple traders on short time frame or lower time frame start to look for buy position, which introduce liquidity in the market. And as multiple traders have been looking for a buy, the institutes can open a sell against them. That means as if they want to open a buy here with 50 billion and sellers are only present with the 10 billion, they can follow the opposite phenomena. As they want to open a buy position, first they're gonna open a sell, which is gonna drop the price. And as when the price is gonna drop, more traders start looking for sell trades as the price is dropping. Then they're gonna open a buy against them. When these sell orders become equal to $50 billion, then the institutes will successfully be able to open a position of $50 billion, as they should always be equal sellers versus equal buyers in case of executions of trade. They should always be equilibrium, because someone has to lose the money so the other can make the money. So in case of ideal trend, because in case of ideal trend, we understand the price always goes in higher highs and higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher high, but once it breaks below the previous high low, it start to go by creating lower highs, lower lows. Lower highs, lower lows. But how these orders and how these highs and lows are being printed in front of us. So behind these highs and lows, when the market makes a high, and when the market makes a low, it basically displays the institutional orders. Here, let's say that institutes wants to open a position of $150 billion. But in order to open a $150 billion order, they need a seller of $150 billion as well. So as if there are not enough sellers present there, so in order to attract seller, they're gonna first open a $50 billion as a sell position, which gonna drop the price. As the price is dropping on, let's say, if the price is dropping on daily time frame, on lower time frame like 1 hour and 15 minutes and 30 minutes, the price is gonna change the trend. As the trend of the on those lower time frame is changed, every indicator or every strategy they are using, it will display and give them a sell signal. So they will start opening the sell orders there. And when that liquidity become equal to $150 billion order for sellers, then the institutes will successfully be able to open a position of $150 billion, which gonna make the price go up. Okay. So now the price is here. Okay. Here, as the price is right now here, institutes open a buy here and they are making a profit with the buy, but they are also losing the money with their sell order, which they open to manipulate traders in the wrong direction. So multiple traders will start looking for sells, then they open buy against them. So in order to close this sell, there are two options. Either they can close this sell in a loss, or they can close this sell by waiting for the price to retrace back to the level where they basically open a sell order. So in order to close this sell, institutes again gonna open a new sell order of $50 billion, which is gonna drop the price. As the price is dropping, when it comes back to their previous sell order level, they're gonna close their previous sell. And when they open this sell, which drop the price, more traders will start look for sell trades. And when the liquidity becomes equal to $150 billion for the sellers, they will be again successfully be able to open a position of $150 billion as a long order, which can again create a new high. So institutes are now with two orders. First one here, second one here. They open this $50 billion to manipulate the traders. They close that and the price come back again, create a new higher low. they have closed this order. So they are making a profit with this order as a price is here, but they are also losing the money with their 50 billion sell order. So in order to close the 50 billion sell order, what they can do? Here, as the price is right now, right at that spot, they can again open a new sell order, which is going to drop the price. As you can see, this is their previous high. They open a sell right here to create a new low. As the price was here, when they open a new sell, it retraced the previous high low very deeper. It was a great deep pullback, right? So when the price gives you a deep pullback, that means they are closing their previous sell order, which they opened in profit. Means they have opened a new sell order and they are also closing the previous sell order in a profit because the price is dropping. They have opened a sell order here and the price is right now at that level. So has this caused a deep pullback? They have closed their previous sell in a profit, and then when they open this sell, which makes the price drop, more retail traders start to look for sell trades there, and then institutes again was able to add a new position of $150 billion, which makes the price goes up again. So now they are with these 1, 2, 3 $150 billion orders, which are making tons of money as the price is right there, and they are only losing the money with this 50 billion sell order. So now there are two methods for them to basically start a new trend. As the price is right now, right at the top of high, if they want to close all these $150 billion at the same time, if they close it right here at that spot, the price is going to drop with a huge bearish rally. Okay? Because whenever the price break the high, whenever the price try to cause a reversal, I have seen 20 times out of 100, it gives us straight rallies. And only 80 times when the price caused reversal in an uptrend, I saw lower highs and lower lows. 20 times it gave us huge rally. When it gives us a huge bearish rally after reversal, that means they are closing these orders in a great profit. They close right away in a short span of time, like after every 15 minutes, after every 1 hour, they're closing these orders. That is resulting in a huge bearish rally. But if they do not close this order in a right manner, in a right way, but if they close this order, like let's say as this buy order was making tons of profit, as this was making tons of profit here, if they close both this order, the price is gonna drop again, okay, and gonna break below the low. As this order was basically open here, they're gonna again open a new buy order, which gonna make the price goes up. They will close their previous sell in profit. They're gonna again open a new sell because they have just got a reversal. So at first, if you see, when they were in an uptrend, they were opening these sell to manipulate and a buy to distribute. Sell was manipulation, buy was distribution. Sell was manipulation, buy was distribution. And now as they have changed the trend, every buy is a manipulation, sell is a distribution. Every high buy is a manipulation, sell and lower low is the distribution. Okay? So that is how they basically take trades in the market. But there's one thing. They will only be able to open a position of $150 billion because they will only be able to attract the traders of $150 billion, because only short time frame trader or lower time frame trader, when their strategies start giving them sell signals, but opening their positions there, not those traders who use higher time frame. But let's say that institutes do not want to open a position of $150 billion. They want to open a huge position of $300 or $450 billion. How they can do that? So in order to open a new position of 150 instead of $150 billion, if they want to open a position of $300 or $450 billion, they can cause a rabbit trap. That means if when the market was in a moving uptrend, only those traders were being attracted when the price was giving them a low, right? Only those traders were opening the position when the price was giving them a higher low. But what if the price just break the high low in a downtrend? Because then those traders who use ideal trend, they will cause the ideal trend reversal, and they can expect a lower high and lower low. They can expect a drop, and multiple traders will start looking for sell trade there. They will open their sell positions by putting their stop loss above any levels. They can do that, maybe above the high, maybe above a small percentage, maybe above the breaker blocks or mitigation blocks or fair value gap, they can do that. As they have done that here, so basically this phenomenon, as they have broken below the previous low, this phenomena helps them to introduce more sellers. As more sellers are now looking for sell position, if institutes wants to open a new order of $300 billion, they can buy against them right there. Because when they break below the low, it introduces more sellers there. They start to look for sell position. And now institutes can open a buy against them with $300 or $450 billion, which can again make the price goes up. So in short words, I will say that if institutes wants to open a small position, then they will respect the higher low and then open a small order of $150 billion. Okay. But if they want to open a huge order, then they will liquidate the low and still they will make the price goes up. Because sometimes when they break the low, they cause a reversal. And sometimes when they break the low, they cause the fake out and again continuation of the previous trend. Rabbit trap. Rabbit trap is a fake reversal. That means it's a fake indication of a reversal where this basically trap the traders. Okay. So a rabbit trap is a price action pattern where institutional traders create a false breakout to basically trap traders into believing a trend reversal. Okay, by targeting liquidity pools that are below the lows where major sell stop orders are basically lying, and that are above the highs where major buy stop orders are basically lying. They trap those pending orders and they basically also hit the stop loss for the sellers as well, as they put the stop loss right above the high. So they accumulate those orders and smart money traps unsuspecting traders who anticipate a reversal, only to quickly resume the original trend. This manipulation allows institutions to enter a position at more favorable prices and exploit retail sentiment. So what does that mean? That means basically is when the price basically gives you these kind of moves, here, like you can see, the market was in a strong moving downtrend. Is that right? It was in a strong bearish rally, create a lower high, just a low, a higher high right here before dropping again. So in a downtrend where price should always give you lower highs and lower lows, when it gives you a higher high, that higher high is basically a fake move. Okay? Because in a downtrend, price should only give you lower highs and lower lows. But when it breaks the high and gives you a higher high right here, that is a fake move because that move just happened to trap the traders. So in an uptrend, this is what it looks like, where price should give you higher highs and higher lows. It breaks the low and then again give us some market shift sentiment because when it breaks the low, it was giving us a reversal sign. So multiple traders start looking for a sell trade. But once it breaks the high, it is again a new market structure shift. And afterwards, it again starts to move in an uptrend. So how does we can anticipate a rabbit trap in an uptrend and how we can expect a rabbit trap in a downtrend? So that is the difference between the ideal trend and a rabbit trap. So here if you can see that in ideal trend, where the market is in the uptrend, the price is giving us higher highs and higher lows. But once it breaks a higher low, it just causes a reversal by giving us lower highs and lower lows. Okay, that is ideal trend. In case of rabbit trap, the price is giving us higher highs and higher lows. Suddenly price gives us a lower low, it breaks the structure, but again give us a higher high. Means there is no difference between this and this. Both have broken the lows. But a small difference is at this price caused a reversal, but in this scenario, price caused a continuation of the previous uptrend. Here it was a fake out, here it was a sign of reversal. So how we can predict both of these moves? I will discuss that in my next video, like how we can predict that based on multiple confluences that I use to understand, is this really gonna be an ideal trend reversal or is this gonna be a rabbit trap? Okay, because in both cases, scenarios is the same. But in the first case, institutes basically open a small order of basically $150 billion order. But in the second thing, price, they are opening a huge order of $300 or $450 billion. That's the reason They trap the sellers to attract more sellers there, and then afterwards they open a huge buy order to continue the uptrend. So what is idle trend reversal and rabbit trap in the case of downtrend? Price is giving us lower highs, lower lows, lower high, lower low, lower low, again a higher high, high low, higher high. This break of lower high was a change of trend. It was a reversal. Then price started to go in a uptrend. Here price give us lower high, lower low, lower high, lower low, lower high, lower low, higher high, again lower low. That means rabbit trap in a downtrend is when the price is giving you lower highs and lower lows, it suddenly gives you a higher high, then again start to give you lower lows and cause the continuation of the previous trend. There is no difference between them. At first case, institutes want to open, they want to change the trend and again start to continue with opening position of $150 billion. But in that case, if they want to open a huge order in case of continuation, then they can just break the high of lower high, and then afterwards again start a continuation of the downtrend. So that is the difference between the idle trend and the rabbit trap. And now I'm going to give you some practical examples of them on the real market that will help you to understand them more better. This is an example on gold on 30 minutes time frame. Here we can see that price is in a moving uptrend. It has been creating higher highs and higher lows. And here we can anticipate two traps there. Here the prices give us a bullish rally, then it gives us a higher low, a higher high, a lower low, but then afterwards it again gives us a high, which as it has just also this high candle body is above the previous candle body. So I will consider it a rabbit trap. Okay. So here it is again a high low, a higher high, a higher low, a higher high, and then here you can witness a huge wick below the level, and then again a higher high. So here we can see that in a moving uptrend, price should only give us high highs and high lows, right? Like that. If it gives us a break of high low, it should cause a reversal. But in that case, price has given us a higher high, higher low, higher high, a lower low, but again give us a higher high. Because if you consider this level here, that's the level of candle body. That's the level of candle body. The price just closed the body above it. So for me, this is a higher high. Okay. And I will treat that level as a MSS, market structure shift. Here the price has given us a higher high, higher low, higher high, higher low, higher high. But in case of liquidation, I will consider the wick as well, because liquidation means stop loss hunt. Liquidation means a pending order of sell stop that lies below these lows have been executed. Okay. So for us, we will treat a liquidation, even though if there is a wick below it, we will consider liquidation. But in case of breakout structure, you need a body, the candle close above the level, because that's a more strong indication. You can also consider wick as well, but when in case of the previous high, which you want the price to break, has huge wicks like that, in that case, you can consider the body as well. Okay, because in this one, you can consider the wick. So we got high low, higher high, higher low, higher high, price give us a lower low, but then again start to continue the higher high. So these break of lows were a fake moves. Okay, they just trap the traders in the wrong direction by causing a trap, but their aim was to go in the original direction. Okay. So now let's find some more examples on the other pairs. Here, this is another example about the rabbit trap on euro versus US dollar on 1 hour's time frame. Here we can see that the price is in a strong downtrend by creating a low, a high right at the spot, and then the price again drop. But here, as it is in a strong downtrend, the price start to give you a high, low, a higher high, low, a higher high. So these high highs and lows are basically within the previous lower high, and a lower low, right? So as these highs and lows are within the previous lower high and lower low, for me, there is no reversal until the price break this strong lower high, okay? So I will consider these internal highs and lows very weak in case of reversal, but there is one thing that I will consider very strong, which is the break of highs. Because when the price breaks the highs, that means they are trapping the traders, okay? Because the original direction is basically sell because market is in a very strong downtrend. But when they break the highs, that means they are trapping more and more buyers there because they need the buyers to open sell position. Now after you can see that price break first high, give us a high, high low, then break again a second high. So here in that case, price has broken above the second higher high, but afterwards it again break the low, lower high, and drop. So for me, this is not an ideal example. But in case when you see the market always gives you dynamic price action, it do not give you the textbook examples. So for that reason, I consider this example as well. So for that reason, as the price break above that level here, so in that case, this is gonna be our trap where they basically trap the traders in the wrong direction. Okay. So here they went above the high and then again start to drop and goes down. So that was a trap. That is our MSS right here, because after breaking above the high, price again start to drop and move lower. Because in a strong downtrend, every break of high can be considered as a level of liquidation, and you can expect the price to reverse from it. But you need confirmations, which we will discuss in our next sessions along the way. But right now, this is very important for you to understand. So what happened here? After the price break this prominent low here, they give us a very small low. I will not even consider this as a high, but for lower time frame, it can be the high. And I will not consider this as a strong move of the liquidation. So let's say this, even though if it is right there, low, price give us a huge high of this candle and then again drop. Okay. And afterwards, it gives us a high. It never went above the previous high. But in case of market structure shift, it went above it before going lower. Because in market structure shift, we consider the body of the candle. But for us, I'm going to keep it simple. So there is a lower high, lower low, a higher high, then price drop. And that high high was a trap. In this example, that is a clear-cut example here. Lower low, lower high, lower low, lower high, lower low, higher high, price drop. That higher high right on the spot is a trap, because here the price basically distribute, and here the price basically trap the traders in the wrong direction. They basically introduce their buy orders, and afterwards they basically drop. That resulted in a loss, in a losing trade for the buyers. Here you can find another example again. Lower high, lower low, higher high, small higher high, a lower low. First trap, second higher high, another lower low. So they trap the traders 2 times. Here again, because when the price break this high, they were expecting a reversal to happen. They trap it here for the first time, here for the second time. Okay, because in both cases, here when they break the high, traders will be expecting that to happen. It never did. So here we saw 2 traps. And now the price is again here. What we saw here, we saw a lower high, straight lower low, higher high, lower low. Another trap for the reversal. So in a downtrend, every break of lower high, where they are trapping the traders in thinking that it is a cause of reversal, because ideal trend traders, when the price in the downtrend creating lower highs and lower lows, break the higher high, break the lower high and give us a higher high, they expect a high low and move up. But what if the high low is like that and there is no high high being formed? That is what we call a rabbit trap. That is what is happening here. They give us a higher high, but then again drop. The traders were expecting that. Okay, so that was the example of the rabbit trap, because institutes wants to open a huge order for their sell position. That is the reason they did not want to respect the previous lower high. Instead, they took and liquidate and break the previous lower high, but then again start to drop.